Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
Hey, welcome to another edition of Your Money or Wealth. Joe Anderson here, certified financial planner alongside Mr. Alan Clopine. Are you confused at all about your retirement plan options? Do you have a 401k? How about a Roth provision in your 401k? Should you save into a Roth IRA? Or how about an IRA? Or how about a non-deductible IRA? There's so many different options out there. There's contribution limitations. There's AGI or adjusted gross income limitations. And we're here to help you figure it all out. So don't go anywhere. You're watching another episode of Your Money or Wealth. Like I said, I'm Joe Anderson, president of Pure Financial Advisors. You can always check out purefinancial.com. Get more information about myself, Big Al, and our firm. So I want to dive right in. We got a ton to get through, so let's see what's on my mind today. A lot of you are concerned about your overall retirement. Am I saving enough? Where should I be putting the money? How do I invest the money? Should I take the tax deduction today? Or maybe have the money grow tax-free? I'm telling you, if you understand your retirement plans, you can make your retirement dreams a reality. Most of you don't really understand what to do with the overall retirement plans that you have through your employer or what's offered by the IRS. So to help me figure this out, of course, let's get Big Al Clopine on board. Big Al, what's going on, brother?
Well, it's such an important topic, Joe, because there are a lot of mistakes being made. We see them every single day. People come into our office, and some of those mistakes really are, I would also call them lost opportunities. I mean, it's things that you can be doing that you're not taking advantage of. So on this show, we're going to talk about retirement plans, contribution limits, and the like, and tell you what you can and cannot do, because we want to make sure that you get enough into retirement so that you have the kind of retirement that you really want. Because we know from Bank One, a recent survey, that only 40% of you have more than $25,000 saved. So that means 60% of you have less than $25,000 saved for your retirement. So let's get into some of the mistakes that you're making and some of the missed opportunities. So number one is understanding the contribution limits. Like if you have a 401k, 403b, 457, and the like, do you know how much you can put in on a year-in, year-out basis? Number two is not understanding employer matches. So if you're putting in some money into your own 401k, in most cases your employer is going to match a certain amount, so we'll get into that. The Roth provisions is gigantic. This is a way to have some of your income in retirement be tax-free. And finally, the IRA and how that works with the 401k. There's really a lot to know, but we're going to boil it down very simply. So at the end of this show, you should know exactly what to do for your own retirement. And Joe, it's just one of these things that if people had just a little bit more knowledge, they'd do a better job at saving.
Yeah, well, then you look at a lot of people can't save or they don't want to save. And the biggest thing when it comes to saving for retirement, if you look at the 401k plan, I mean, it's a pre-tax contribution, so all you have to do is check a box. So I want to start there because there's a lot of misconceptions with how much money that you can put into a retirement account. Here's the deal. It's $17,500, $17,500. It's not based on a percentage. How many times have you heard this, Al? Well, I can't put in $17,000 or I'm maxing out my plan, and we look at their statements and they're only putting in $8,000, $9,000, $10,000 because they're based on old rules. Right now, the rules state is that you can put in $17,500 dollar for dollar on those plans, unless it's, I mean, we can get real technical. If it's a top-heavy plan, if you're a highly compensated employee, for I would say 90% of our viewers, it's $17,500, and then you get the catch-up of $5,500.
Yeah, exactly. So that means $23,000 if you're 50 and older. And a lot of you have old plans that, or think you had old plans where it used to be you could only put in about 20%. 15% of your compensation. Now most of the plans have changed so that where you can put in 100% of your compensation up to those limits. And Joe, talking about a really good example is an educator, a teacher, someone that's 50 years and older. They have a couple plans. Generally, the school district allows them to put money into a 403b and a 457 both, so $23,000 each into each plan. It's gigantic.
So if you look at it like this and say, all right, well, is there ways that you can create deductions? And the retirement plan is one of the biggest deductions that you can basically have right now if you're currently employed. So if you are a teacher, if you are an educator, you have two different plans. And this is another misconception. You have a 403B plan and a 457 plan that you both can max out. So if I'm working and let's say my paycheck is $80,000, I can contribute to both plans, 403B and 457. I could reduce my income by that level and then max those plans out and really jumpstart a retirement. Another thing I could do as well, if I'm maxing out a retirement account, Al, I think some people don't think that they can still contribute to a retirement account or like an individual retirement account, an IRA.
Exactly, and the amounts there, $5,500 per person for an IRA or $6,500 if you're 50 and older. Now, the only reason where you wouldn't be able to do that is if you're 70 and a half or older, but for the rest of you, you can actually do that in addition to your 403B, 457, 401k, and the like. So realize there are a lot of ways to get money into your retirement, and you just need to know what they are.
So if you start late, right, there's always options. You can get into the game. You know, if you look at what Bankrate.com said, the average balance of some retirement plan is some 20-some-odd thousand bucks. It's never too late to start. So that's the point. So if you can find additional dollars to put into the overall plan, especially if you're getting a little bit older and you're saying, hey, now the kids are out of school, now the kids are out of the nest, now it's time to focus on me and my retirement accounts, you can max out these plans, and we would encourage you to do so. Or we can take a look at, all right, well, let's see what other options that you have. Don't go anywhere. When we get back from the break, it's hotter than Haiti in here, Al. I'm sweating up a storm.
Well, it is summer.
I'm talking retirement plans, and I'm going bananas here. I'm talking $17,500. We got to get you motivated to start making some money in your overall retirement. Because when we get back, we got a lot more to go. Get in for a free retirement review. Call this number right now, 888-994-6257. Call the number, figure out your plan options, and get your retirement on track. We're here to help, and by the way, it's free of charge. When we get back, we're going to get into some examples. If you're a little bit behind the eight ball, what the power of compounding can do. You're watching Your Money, Your Wealth.
My retirement?
My retirement?
My retirement?
I'm looking forward to moving my bedroom to the first floor.
I just want to watch my equity crumble.
I plan to spend the rest of my retirement going no further than the end of my driveway.
Prisoner in my own house.
At the mercy of countless repairmen.
My retirement?
My retirement?
I want to spend my retirement feeling like a stranger in my own neighborhood.
Eating TV dinners at home alone.
Eating TV dinners at home alone.
It doesn't sound good at all.
Doesn't that sound great, Al?
That's why you got to watch the rest of our show so this doesn't happen to you.
I mean, that is just sad, right? I don't want to drive further than the end of my driveway. I want to spend the rest of my life alone. That is not retirement. That is not retirement. You need a plan for retirement. So do this. Come into our office, get a free retirement review. We can take a look at everything for you and let you know, are you on track, not on track, so you don't have to live the life like that awful, awful, scary video. Don't have nightmares about it, because I might. 888-994-6257. Call that number right now. And then here, this is some really bad advice out there. So when you get advice, you have to be careful where you get it from. So come to us and don't go to this guy, whatever you do.
So why don't we get into the true-false question?
What? True-false?
Yeah,
okay,
here we go.
Whatever.
If I had 2 jobs, I can contribute the maximum of $17,500 to my 401k with each employer.
I wish that was the case.
I wish so too. That is absolutely false. When it comes to 401k, it's just the one plan, even if you have multiple employers. Now, we did talk last segment, if you're a teacher and you have a 403b and a 457, you can do $17,500 each. But in the 401k world with different employers, you can just do the one, and that's it.
Yeah, right. If you're working at 2 jobs, you got 2 different 401k plans. It's $17,500 max or $23,000 total for the Section 401k plan. So unfortunately, that is false. It's $17,500 or $23,000.
Yeah, if you're 50 or over.
If you're 50 or over,
Yes.
Al. See, we're just rolling.
Right there.
Right there. So now what? We're going to go to the worst
We've got a video.
worst advice ever, which I thought we were going to play earlier. So why don't we play it now?
So the number one thing I want to tell you kids, and what I tell myself, knowing what I know now to go back 10, 15 years, is not only don't invest for retirement, don't save for retirement, but please let go of the guilt. Forgive yourself for not doing it, because there's always that thing you should. I'm telling you now, you shouldn't.
Can you say quack?
Yeah, just don't do it, right? You know, be a burden on someone else, and just you don't have to save it all. I mean, but here's the problem is that I think there's a lot of hopelessness when it comes to the overall retirement planning. It's like, all right, well, here I'm getting into my 50s and 60s, and maybe I haven't done the planning, and so now I'm not going to feel guilty. I'm not going to do anything, and hopefully the cards fall where they lay. Don't do that, because it's never too late to start. I don't care if you're 20 years old. I don't care if you're 70 years old. All you need to do is put a plan in action to figure out exactly what you need to do and put a couple of things through the asset test, and you are going to be okay. We'll show you a couple of different examples, because if you understand how your retirement plan works through your employer, I mean, you can see the compounding, right? Albert Einstein thought the biggest discovery he ever discovered was compound interest. And then if you throw an employer match on that, plus the pre-tax contributions, you can really see some wealth grow fairly quickly.
Well, that's exactly right. And so let's jump right into it. So here is a way to jumpstart your retirement, and that is your company is going to make some of the match for you to put some money in for your retirement plan. And commonly, companies match about 4%. That means if you put 4 or 5% of your pay, a lot of companies will match that 4%. And some companies even match higher amounts. So don't underestimate the power of you putting in a few percent and then your company matches it. It's very powerful.
Yeah, so if you take a look at it like this, here's the quick example, right? So we got James here. Let's say he's making $100,000 a year, and then he wants to contribute. He wants to start. He's never started to contribute to his plan, and then let's just use a 4%. 4% match, and then he's only going to put into the plan up to the match. So 4% of $100,000 is $4,000, and then they're going to match dollar for dollar on top of that. So let's just assume $8,000 total going into the plan. So if I have $100,000 income, so this is the first step, right? 100K. Well, if I want to put in 4%, well, that is what? $4,000. What? 4K. But this is also a pre-tax contribution, and this looks really professional. So that's why you should watch this show, because we don't mess around.
Did you get through nursery school?
Yeah, but no. See, look at the next slide, Al. We're moving here. So then it's the $8,000 per year is going into the plan. And let's just assume he's going to save for the next 30 years. And we'll assume a 7% growth rate on that money. That's $756,000. That's not chump change, folks. That's a lot of money. Now, what did it cost James in this example? He put in 4%, $4,000. Well, Al, if I'm putting money into a pre-tax account, what is that true cost to me? So $4,000 total is going into the account, but what did it truly cost James?
Yeah, because if we assume he's in a 25% tax bracket, he saved $1,000 just to get the money in. So it really only cost him $3,000 to put $4,000 into his retirement account.
So if you think of it like this, $3,000 a year, okay, so that's $250 a month. That's a few dollars, that's a few lattes a day. That is not going to coffee, that is going into your retirement account. You let that compound over 30 years, now you have close to $1 million of assets. It's not that, but now I know a lot of you are saying, what the heck, Joe, I don't have 30 years. Man, my kids, I should have my kids come in the living room right now and take a look at the show so they can start saving the $250. You know what, let's do another example, Al, of someone that's 50 years of age and then has maybe a little bit of savings to see what the situation looks like there.
Yeah, maybe let's start with what, maybe $100,000 at age 50, and you're thinking, you know what, it's going to take forever for me to get to a much higher balance, right, to $700,000, $800,000. But look at this example, 15 years to work, you got $100,000 to start. Now, we want you to save, in this example, about $10,000 per year, or 10%. You still get a match, but within 15 years at 65 at 7%, you got $627,000. These last few years of retirement are very significant in terms of your overall enjoyment.
So if you look at the statistics, Al just talked about what the average balance of someone's retirement plan is, what, $25,000, something like that. All you have to do is save a couple of pennies. Now I'm 50. I was able to save maybe $100,000. Maybe it's $50,000. Maybe it's $150,000. We're just giving some examples here to get rid of the hopelessness. Because now, all right, well, maybe I can save $10,000. But the true cost of this, I'm 50 years old, I'm in my peak earning years. Well, it's not going to cost you 10 grand. It's going to cost you close to $7,000. Maybe it's $600 a month. All right, at age 50, maybe I'm making a little bit more money, $600 a month. Can you find that? Or start somewhere to get you there. The point is this: in 15 short years, when you turn 65, you have $627,000. I mean, you're in the top 5 percentile of people's assets. That's what we're talking about. It's not like, here, let's save some money to make you 50,000 or to get you to 50,000. It's just slowly building up to create true wealth, right? If you look at the millionaire next door, they don't make hundreds of thousands of dollars. What they do is they spend less than what they earn, and they have a disciplined strategy to make sure that they can accomplish their goals. You can do this too. All you need is a roadmap. If you want our help, we're giving away a free retirement review. So come into our office. Here's the number. It's 888-994-6257. That's 888-994-6257. 888-99. Call. It's absolutely free. Sit down with the CFP board certified professional. We can map things out for you to tell you exactly what you need to do. It's not impossible. You just want to make sure that you take the bull by the horns and then take some action. Hey, we're going to look at some Roth provisions because there's other things inside the plan that you also might want to take a look at as well.
Yeah, and so let's discuss that, because many 401k plans, 403bs and so forth, they have Roth provisions. And so that means that you can designate some of your pay to go into a Roth option. Now, you will not get a tax deduction for those dollars as you do a regular 401k contribution, but the dollars in the 401k, the Roth 401k, grow 100% tax-free for your lifetime. And get this, there's no income limitations. When you do a Roth contribution, which is different, this is the $5,500 or $6,500 if you're 50 and above, you have to be below certain income levels. But in terms of a 401k, there are no income limitations. Anyone that has a plan that has a Roth provision is able to start putting money into a Roth 401k, meaning that some of their income in retirement is going to be tax-free.
Last study I saw, Al, there's about 60% of all plans, and this is going to be the norm probably in the next year or two, is that all plans are going to have this Roth provision. So now you can create that tax diversification. So some of it's going to come to you as tax-free income for life. So then it's playing with the options that you have in your 401k plan to build the sum of money that you need to provide the lifestyle that you want, but then you can also reduce taxes at the same time. It doesn't matter how much that you make. A lot of people weren't able to contribute to Roth IRAs. Now with this Roth provision in the 401k plan, everyone that has that plan can put a ton of money into a tax-free environment. It's a huge deal. You just got to put the pieces together. We're here to help you. Call the number again, 888-994-6257. We're going to come back. We're going to take some emails, hopefully. We got an email bag that's been building up for the last, 6-8 months. So we'll try to get to one or two of those. Don't go anywhere. We got a lot more to discuss on your money, and it's your wealth.
Congratulations, Mr. and Mrs. Parker, on your retirement. We'll be happy to cash out your retirement account today. Just a few of the details. Great. Now let me go get your money. There's a little bit more. Okay, we have 5, 10, 15, 20. That's it.
Ow. Do not let that retirement scenario happen to you. Could you imagine going to the bank, cashing out your retirement accounts? First of all, you don't go to a bank and cash out your retirement accounts because you'll get destroyed with taxes. But if the money that you thought you had saved is now worthless, it's not a good feeling. You could just see it in their face. So here's a couple of things that I would encourage you to do. I teach a retirement planning course all over Southern California. And if you want to go to a class, you can go to yourmoneyyourwealth.com and get educated. I'm looking at different scenarios on how to help you provide yourself with the best retirement possible. We go soup to nuts on everything that you need to do on your own. I'm telling you, everyone out there needs a financial plan. Everyone doesn't necessarily need a financial planner. So if you want to learn how to do some of these strategies on your own, really get educated on all the ins and outs of how the stock market works, the tax code, and create the overall retirement income that you need for a very long time, attend the course. Just go to yourmoneyyourwealth.com, yourmoneyyourwealth.com. And right there, just on the icon, you can click and you can see the schedule where I'm going to be at over the next couple of months. Guess what? It's fall, folks. It's back to school. That means you too. So I would encourage you to go to yourmoneyyourwealth.com. Just click on the icon, and then you can get into one of our courses coming up this fall. Now, let's go to the true-false question.
All right, here we go. If my employer has a 401k with a Roth provision, I can contribute $17,500 in that plan and also contribute $5,500 to a Roth IRA.
So, I mean, here's the deal. When you look at that, that's a that's a great question, because a lot of times, if I'm contributing to my retirement account, fully funding at $17,500, sometimes people think, well, here I cannot contribute to another account. The answer is true and false, Al.
Well,
it depends.
It depends, but it's mainly true, but it's subject to income limitations. So if you're married, for example, and if you make more than $181,000, that $5,500 contribution starts getting phased out. In fact, it's $181,000 to $191,000 for a married couple. For a single taxpayer, that phase out is $114,000 to $129,000. So that means if you're single and you make more than $129,000 of income, you cannot do a Roth contribution. But if you're below those levels, you can do it and still fully fund your Roth 401k.
So you can put the money into the 401k plan and the Roth if you are under those income limitations. So you can do both plans. It's a huge deal. Now it's time to really catch up on some of your savings. Al, let's go to the next email question.
All right, here we go. This is from Terrence in Temecula. As a self-employed business owner, what are the different types of retirement plans available? And I'll start by answering that. Terrence, there are quite a few plans, starting with the SEP IRA and the simple plans. These are where most businesses start, not necessarily the best plans, but it's a way to go. Both of the SEP plan is probably the most common. You can put about 25% of your salary or 20% of your profit if you're a sole proprietorship. Then there's sole 401k plans. If you don't have any employees, there's safe harbor 401ks. If you do have employees, there are profit-sharing plans, and the granddaddy of them all is a defined benefit plan, because there you can put a lot of money away. And for those of you that are in your 50s or 60s and you don't have a lot of employees but you have a lot of profit, a defined benefit plan could be a fantastic way to go. You may be able to put a couple $100,000 away each year.
Now, how long have you been a CPA?
I'd say about 30 years.
So you've been doing tax returns or looking at tax 1040s for 30 years.
Correct.
And so you've helped a lot of small business owners out. And would you say that this is probably one of the biggest things that is missed by a small business owner, is that the most popular accounts are still the SEP IRA, the self-employment pension plans. But even though the solo 401k might be a better option if they're a sole proprietor or maybe just a one individual employed business.
Yeah, that's exactly right. And the SEP is the one, it's the default, because you can set that up after the year's over, all the way to your tax filing date, which if you're a corporation, it's March 15th, and you can extend it to September 15th. You can set it up all the way to the filing date. Now, 401k, you got to think ahead. A solo 401k, you have to set up by year end, even though you don't have to put the money in until the tax return is due. But if you'll set up that account before year end, you can put up to $17,500 into it, dollar for dollar, plus a profit sharing portion, which, by the way, is the same calculation as a SEP. So you can put a whole bunch more into 401k.
Yeah, you can put, what, close to $50,000 into the account. The problem is that you got to get the account set up before year end.
Correct.
So that's another reason that you might want to see a qualified professional before year end to take a look at your overall situation to see what is appropriate to you. Let's go to the last email question, and then we got to wrap it up.
Here we go. My accountant told me that a defined benefit plan will generate the biggest tax deduction. How do these plans work? And this is from Kathleen in Carlsbad. And the way that these plans work is they're based upon actuarial tables, based upon your age, income, years of service, how close you are to retirement. And those that are the closest to retirement, you can put large contributions, sometimes in excess of $200,000. We've seen contributions in excess of $300,000, even $350,000 into this plan. It's great if you got a small business with high profits and no employees or very few employees, because you have to include the employees as well. But let's say you don't have any employees and you have a lot of profits. What if all of a sudden you got a $300,000 tax deduction? Can you imagine saving $100,000, $150,000 in tax? It's a pretty good deal.
Yeah, I mean, so if you're making a lot of money, there's all sorts of different types of plans. If you want to put $10 away a year, if you want to put $300,000 a year away, there's all sorts of different things that you want to make sure that you consider. Here's the bottom line: get some help from a qualified professional. Work with a CPA, work with a certified financial planner. Make sure that they're working from a fiduciary standpoint, that they're not selling you products, that they're taking a look and making sure that you're doing everything appropriately. If you want to use our firm, that's great. You can always call us. We'll give you a free retirement review, a retirement plan review to see what makes sense for you. The number's right there on the screen. It's 888-994-6257. Would love to help you out. Come on in. It's free. The phone lines are open, so pick up the phone and call. Have a wonderful weekend. That's it for us again. Next week, you know what? We have no idea what we're going to talk about. I'm told you to tease you, but I have no idea because we have no idea what the show's going to be. We don't figure it out until like 5 minutes before the show. Stick around, though. It's going to be great. I'm going to tell you that for sure. For Big Al Clopine, I'm Joe Anderson. You're watching Your Money, Your Wealth.